Yeah.
All right, well, we're going to go ahead and get started. We have 93, 94 people. Welcome, everyone. My name is Chuck Evans. This is the 30 at Noon webinar series. And this series is not designed, as I mentioned earlier, to replace any of the training that NADCO does or any of the training that NAGLE does or any other of those very good platforms. We try to bring you industry stakeholders that have a good reputation, know what they're doing, and kind of share best practices. And so today I'm bringing all my colleagues in. It's David Tinsley heads up our LSP team in Birmingham, Alabama. Rachel Hunsinger is heading up servicing and liquidation for Lenders Cooperative. And Julie Middleton was with Ventures, and now Ventures is with Lenders Cooperative. So it's a good group. We're going to talk about a couple things today, but before we do, let's get some housekeeping out of the way. David, do you want to go ahead and give us the commercial so marketing will be happy with us?
Sure, certainly. So Lenders Cooperative, as you said, is a really it's a system to try to bring together a combination of sort of bank-enabled tech combined with subject matter expertise on the labor piece of it as well. So everything from originating all the way through to servicing and operational pieces involved with that too, and really small business lending or banking in general. And so that's who we are. Love to have more conversations with everybody. And to finish up the housekeeping piece of it, Chuck, please be interactive. We have a Q&A option for you there. I'll be monitoring those questions as we go through the webinar, and I'll try to make sure we're either answering them or queuing them up for the next so that we can do that. It's a lot more fun to make sure that we're discussing things that are relevant to you, especially from a timeliness perspective. So please do utilize that. And that's the Q&A. If you send the chat, I'm not sure we'll see it. But anyway,
Okay,
all right.
very good.
Thank you,
Thank
Chuck.
you. One other thing, we're going to tell you what's coming up in the 30 at Noon webinar series rather than waiting till the end. The next one, we're inviting 4 or 5 really good friends that are industry stakeholders, 2 are SBA managers, 2 are CDC directors, and Brent Cherlino, who was the former director of Office of Credit Risk Management. Hilda Kennedy, founder of Ampac Business Capital, is going to join us. She's a NADCO board member. Danny Mangum from Mountain West CDC is going to join us, and he's running for NADCO board. We have Sherry Martin from Citizens Trust Bank in Georgia. She's running for NAGLE board. And finally, Michelle Verbleed from Customers Bank, who's also running for NAGLE board. So they're going to share their vision with you folks as to the next 6 to 12 months. We've had some changes with the SBA. We've lost some really good people at headquarters, and everything seems to be moving quickly. And we just want to make sure everybody's on the same page going forward. So that's the housekeeping. Let's get started. Today we want to talk, we've gone to these conferences, America East, all of them, and everyone focuses on originations. Everyone focuses on how many loans we've done. We've done 31, $32 billion. And to me, the topic that doesn't come up outside of the Office of Credit Risk Management is servicing and liquidation and managing what Okram feels is an emerging risk in our portfolios. So we've been focusing on that. We had Lindsay Rowland from Starfield and Smith. We had Stephen Hayes from our team going over a risk profile. Today, I kind of wanted to talk a little bit about how we can be more proactive in servicing, how we can use technology in servicing and liquidations. Because Rachel, tell me if I'm wrong, you can lose your guarantee in as much in closing or servicing as you can in origination. Am I right?
It's actually typically people lose their guarantee the most after the loan closes. So once that loan is serviced.
There we go. David, I'd like you to kind of summarize. You've done a couple panels, the last conferences on small business lending, emerging risk. Could you just share a little bit of that before we get started?
Oh yeah, absolutely. So the big focus has been on the shift back from what the do what you do. It was heavily focused really more so on smaller dollar lending. So at the time it was 500 and under. That's since, been lowered back to 350 and under for at least the small 7A loans. Express is still at that $500 level. And what does prudent lending look like, right? So the freedom, I mean, there really is some freedom there. in the smaller space, but that's not the same thing as prudent. And so really, there's obviously been a heavy focus in the communication from SBA, from like Okram, and just other peers within the industry are saying it's more than just figuring out what the SBSS score and then what's the bare minimum that I have to do in order to get this sent across. The question is whether or not you're addressing the items that will in the end help the portfolio be successful. Because you could follow all the bare minimums across the board, but SBA is going to have a question for you if you followed the minimums and the portfolio is not performing. And because that's still you having to be a good steward. So really, a couple of things that were interesting that we brought out with, and it's really to Rachel's point as well. You're going through all these steps, so it's really important that you've set the loan up correctly. But what's more important is that you set it up to be successful. Not just that I followed those rules to get it there. And so then what are you as a lender doing to monitor those? So I know we're going to jump in and talk about that a little bit more, but some interesting things to keep note of is that a small dollar loan is about 2.5 times more likely to either, or let's say that your average losses for a small dollar loan are about 2.5 times larger compared to a larger loan. And there are ways to mitigate that. But what tends to happen is that banks or lenders tend to find more manual processes that they layer on there, which means you end up actually having a lot fewer approvals. And when you're considering, you need to be about 6 times as efficient with these smaller loans, because from just a general return on your the return on the loan itself as an asset, as a performing asset on your books, obviously it's far less compared to the effort that you're putting into it. So that was a heavy focus over the conferences. People are looking at it. How do I find ways to do more of these? How do I find ways to do them efficiently? But how do I also not give up sort of that prudent lending? How do I maintain reasonable commercial practices as we're adding them in there? And so obviously happy to discuss that in greater detail, but that's really what it comes down to, is making sure that we're honoring the program, being a good steward, but at the same time setting it up for success.
They led for it at each conference is set emerging risk. And so that's the focus. Rachel, let's talk about tips and tricks for proactive servicing if you can. I have some questions, but go ahead if you have some comments you'd like to share with the crowd.
I mean, your questions will probably segue into this, but I think the biggest thing that I can say, and I always share with lenders, is if it's not in your file, it doesn't exist. The first tips and tricks is to document. Can't tell you how many times I speak to lenders that say, well, borrower said thus and so, or even the borrower comes back and says, lender said thus and so. Well, where is it? When you're going through an audit, or you're internal or external, if it's not there, if it's not somewhere tangible that you can follow back on and refer back to, it doesn't exist. So everything that you can do to document your file, no matter how minute and insignificant a piece of information may seem, that is what is ultimately going to protect your guarantee, is that documentation of what you, especially as a lender, has done. Because think of from the origination side, we have the borrower go through many exercises to ensure that the loan is eligible, that they are eligible. There's some checklists and some criteria that they have to cover that is usually gift wrapped for them, right? It's pretty black and white of, if you don't do this or you don't meet this criteria, the loan is ineligible. Once the loan hits that servicing side, so it's closed, the onus for protecting the guarantee is on the lender. At that point, the borrower's done what they've done. Yes, there's all of those technical default triggers in the note that we know our borrowers are so great at reading and understanding what they mean. Can lead a horse to water, you can't make them drink, right? Constantly telling lenders when they ask me, well, what do I do if a borrower doesn't execute on those items that trigger those technical defaults? The best thing you can do as a lender is to protect yourself by proving that you have at least done your due diligence. If you have reason to believe that the borrower has moved their collateral without your permission, get that site visit documented in your file. Again, the onus is on you to protect that guarantee. Follow up on your insurance. Make sure that you're doing those annual reviews. That is how you protect it, is by being a prudent lender through the life of the loan.
How do you develop a cadence in portfolio management with borrower contact and communication? Any tips there?
Using a robust tickler system,
Mhm.
and I would little plug here, technology helps with that. The more manual you become, the more labor intensive, the easier it is for that stuff to slip through the cracks. Um, Not a fan of the manual work because of the um, likelihood of that human error. If you put in a tickler date and put it in incorrectly, transpose a number, and now you're not following up on that in the right time frame because it's, you know, 6 months down the road instead of 3 months, you've already lost something that you should have been tracking. So maintaining a really robust tickler system helps with that communication of what do I need to follow up on. Just constantly taking a pulse. A lot of lenders now um, we're living in a day and age where less likely that your borrower is just going to constantly walk into your branch or that you're going to have that physical touch. We have the online banking capabilities, your ATMs, your after hours things. So just make sure that you have that constant touch with your borrower. Set up ticklers so that you remind yourself to do that. At minimum, do an annual review to ensure that you are getting boots to the ground, pick up the phone, send an email, know your borrower's trends. If it's somebody that you're usually hearing from and you don't, that should be a trigger. But definitely with that communication, you cannot over communicate and have ticklers in place to ensure that you're doing that at the right times.
Okay. What would you say are the top 5 mistakes in servicing and liquidation the staff makes that impacts the guarantee? Could you share us a little bit about that?
Probably first and foremost, assuming that your SBA portfolio needs to be managed in the same way that your conventional portfolio does. Aside from the SBA stating that if you have an internal policy that directly identifies specifics, what is our annual loan review criteria, things of that nature, you have to at minimum service that loan the same way you do conventionally. Above and beyond that, there are very specific things that the SBA wants you to do, and especially in the liquidation arena. Um, you may not be able to foreclose on a property in the same way that you do. You may have to use a specific time frame. I've spoken to some conventional lenders where, if the loan goes 30 days past due, they immediately try to shut down the business, start foreclosing. Well, you can't do that with an SBA loan unless there are other triggers going on there. So know your SOP, know what you can and cannot do where it relates to your SBA loans as opposed to the conventional loans. So I would say that's probably first and foremost. Understand that you are working with a completely different program and book of business here on your SBA loans. Second, can't say it again, failure to document. Document your site visits, document your touch points, keeping a chronology of conversations, even if it's something simple. Borrower reached out to make an extra payment. Borrower reached out because they are looking to potentially sell their home in 3 months. All of that information helps you to compile a robust summary of that communication, which ultimately is going to allow you to deliver better service, but also to, again, to prove to the SBA that you have remained in contact with your borrower. You are aware of the health of your portfolio and that loan in particular. Mistake number 3, not tracking and monitoring for that documentation. Insurance and financial statements, insurance being a huge one. Going back to, again, that you can ask for it, but they may not give it. Be proactive with that. Establish a relationship with your insurance agents that you're working with. Don't allow those insurance policies to go past due. If you have to start tracking those, following up on them 6 months before they expire, 3 months before they expire, don't wait for that 30-day, because oftentimes borrowers are changing policy holders, they're changing agents, and you get to the point where you're asking for a binder that is now 30 days expired because you're reaching out to an agent that they no longer work with. So be proactive with those types of things. Force place if you have to. Use that as an opportunity to have a site visit or an inspection with your borrower. So I would say that's definitely a big mistake there, is letting things like your insurance slip through the cracks. Ultimately, the portfolio monitoring in general, I think I've said this before, and as you mentioned on the beginning of the call, origination is such a big focus. It's a big push. We need that. You have to have production. It's what keeps your doors open. But oftentimes, especially if you don't have the seasoned team or the capacity, the skill set that you need, all of those servicing portfolio management activities are going to fall by the wayside. Think of an annual loan review. If you're sharing your credit talent with your portfolio management team, and they have a choice between spreading financials for a new loan
Yeah.
versus doing an annual review. They're going to pick the new loan. And then what you see is that 6, 8, 12 months have gone by and you haven't conducted that annual review. And sometimes, 4 or 5 years have gone by and you haven't even touched that borrower through an annual review. So that would be another mistake. I don't think that lists 5, but those are kind of, I think, the key
Not one.
and mistakes.
Lindsay Rowland brought up an issue when we get into liquidation. We use SBA experienced attorneys in just about
Yeah,
everything,
yeah,
and many times the lenders are very competent in originations, competent in closing, competent in servicing, but they're not quite as competent in liquidations. And so then they engage local counsel
yeah.
that really doesn't know SBA. What
Mhm.
happens next?
Well, that's where things can really fall apart. So,
Yep.
and I'll also remind that, again, going back to SOP, the SBA doesn't suggest, they require that you use a local attorney. And by local, they mean somebody who truly can knock on that borrower's door. Not are they in the same state, but 4 hours away, right? So local, you need to make sure that they can put boots to the ground with that borrower. Also, you want an attorney that knows SBA lending. You want them to know that state specific rule. And if there are
Mhm.
other layers and nuances in there, if you've got a bankruptcy or other judgments, do they have the experience in that? Because just because they may know SBA doesn't mean they've ever worked with a bankruptcy. So you really want to vet your attorneys well to ensure that they are working as diligently and aggressively and proactively on your behalf as they possibly can, and network with attorneys that are not afraid to leverage some of their network of attorneys as well, some of their peers. I've had the pleasure of working with attorneys that will say, Rachel, I've done XYZ, and yes, I know SBA lending, but no, I haven't touched this particular situation, but I have a great partner who can. Let me refer you to them because I want to make sure that you, as the lender, has the best representation. So definitely vet your attorneys. Don't be afraid to reach out to someone and ask who they recommend. And it's probably not going to be the same attorney that you're using to close your conventional loans. It's probably not going to be the same attorney that you're using to even close your SBA loans. Again, you want somebody who's well versed and experienced in how to liquidate a loan to the SBA standards.
Certainly, the CDCs have a designated counsel, so
Yeah,
that's always a plus. But the 7A lenders tend to want to go to somebody local that really just doesn't know it. So that's a good point.
yeah.
Well,
David, I'm going to
Chuck,
put you on the spot for a second because you manage our closings too. And what are some of the hot points in what we miss and what it comes back to bite us?
so let me say one thing that I've noticed as well is that many of the lenders, so it's kind of like 3 or 4 points, but what will
Okay.
happen is that you don't, an argument from silence is a terrible place to start with. And so when you're comparing to your conventional portfolio or your conventional policy, let's say there's certain items that SBA really gives you levels of requirements, or it gives you a comparison to your conventional portfolio. And if you're silent from there, that doesn't mean you don't do anything. Like that. So oftentimes you're sort of at a weak position already. So it's really important that not only are you familiar with with the servicing SOP or with the origination SOP, but at the same time, what is your policy, and are you silent to areas that you really should have some guidance? Because you can give your, I think where Okram has to come in there reviewing something is that they have to start with, well, what does your policy say? And if you're silent to it, they get to decide what's reasonable and what's prudent. And that may not be what you think it is, but if you've clearly said, here's what we do, here's what and then you're following the thing, you're at least at a better footing. And I bring that up because when you're closing the loans, that's the more common place that I see it. They're like, well, what does SBA require? SBA may require this, but that doesn't necessarily mean that's the standard you should lower it to. There are cases where you would say it might be more prudent to take some sort of higher position on a level that you're working on. And what I'll also say is that oftentimes, and it's different for each size lender, but when you're partnering with somebody that's doing the liquidation, it might be a wholly different department, even within your bank, right? So they have policies they follow on how to liquidate, but they don't appreciate the nuances of doing a 7A loan. And if you're doing it well, they may not see many 7A loans that they're having to liquidate because it's not like you have 5,000 of them sitting out there. That's not the average SBA lender. So if you only see a couple of loans every now and then, it's really important that you have a good relationship. You're stepping out there and saying, "Hey, listen, before you get started on this, let me remind you." And I see that to be true definitely across the board, closing into servicing, all of that. Is that you're talking with your partners in your institution, right as you're doing that. But the other thing is this: so when you're getting ready to close a loan, I'm asked the question all the time: Can we get this post close? Gosh, that's got to be the biggest bane of our existence
Insurance,
when it
yeah,
comes to
just
that sort of thing. It's like, how can we get it post close? Um,
Rachel gets
yeah,
pissed at us
you
when we do that,
you
right?
can. Yeah, I'd say certainly you could. It
Rachel
might be a
puts you in
terrible
timeout.
idea. Yeah, exactly. And so it's one of those things that the question I've always asked them is like, it really doesn't matter unless it matters, and then it really, really matters. There's not really a middle ground here. And so if I need it so that the guarantee is secure, then you really shouldn't make that post close. At the same time as if I need it, but it's something because of the local laws, the way it works, if it's you must have this in place before the city will issue the license to do this, well, then you have to do it that way. And you document all the ways you tried to look out for SBA in the process. I mean, but everything needs to be an intentional, not a, well, we're in a hurry, or what's the fact, they're leaving the country, right? Or something like that. It seems to always be the one that we run into. And so it's really about, that's 5 years from now, when you're into this loan and maybe you're liquidating it, the 2 or 3 week difference between getting it and not getting it is not going to feel very comforting. And so that's what it really boils down to, is how important is this? Would we make the loan without it? Okay, well, then maybe we proceed. We can follow it up for it post-close, but we would have been comfortable without it. Well, maybe that's okay. But if it's absolutely not, we do this or we don't do it at all, that's got to be part of the conversation. Anyway, those are my thoughts.
Thanks. Well, a lot of the banks that manage their programs have managed them historically in Excel, right? We all have. And now with scale coming and with technology available, as I said, most of the technology platforms have been focusing on origination and closing, but there are servicing platforms out there. We have one, and I don't want it to be a commercial, but I want to introduce Julie Middleton, who manages the Ventures platform. I want to talk a little bit about how we use technology to be better servicers and liquidators. Maybe Julie, you could chime in first.
Thank you, Chuck. Yes, I mean, we've been doing this for many, many years. I think we're up to about 35 years of working with lenders on the servicing aspect of a system. And as Rachel said, ticklers, that's key. So in ventures, we do have the ability for you to set up ticklers that are tied to insurance, your financials, UCCs, things like field visits, just a whole gamut, even creating ones that maybe just internally, they're not connected to anything that we set up as a default, but having it set so it has those reminders that go out. It's not just a one-time request and then you forget about it. You need to continue to follow it up and show that you're doing that outreach. Now, part of what really gets me excited now that we're part of Lenders Cooperative, and we made the announcement earlier this week to some lenders, ventures lenders, and we'll be doing it again on September 3rd, that we are moving towards one unified platform. And so in doing so, this is the time that we're taking a step back and looking at what can we improve? A lot has taken place since Ventures was originally created for ticklers and loan covenant tracking. Now there's borrower portals, so how can we take advantage of the newer technology? Some great things that we already do is getting a stack of tax returns in electronically and being able to spread those to all of the loans that have provided those returns. That speeds up the process of doing your annual review. If you can get those tax returns spread and someone's not manually inputting those numbers, that's extremely helpful. Also, as we can use the portal, we'll be able to upload, borrowers will be able to upload their insurance, those other items where you can take that piece out of having to manually move it from email to your, to your system of record. So a lot of things are going to progress in that direction. But that's key. We also have a risk rating system that you are able to set up how your own internal policy is as far as how you risk rate those loans. And then you're able to grade them and see the tracking over the years as far as how they were graded, be able to pull reports across your portfolio as far as, what is that rating, and be able to see if somebody's changed from a rate and all of a sudden they've dropped 2 points from the last one. So all of that is important to be able to track.
I think with the borrower portal, the borrower engagement has increased. And historically, they get statements, they get bills, they get calls every now and then. But if they can go online and see the activity, that makes them more engaged, and it might minimize some of the risk down the road. Is that a fair statement?
Yeah, definitely. And then, of course, you're recording messages back and forth from them. So that's all helping in that record keeping, that you're not having to manually make those postings that you might forget.
I like the idea of the integrations, the UCC searches, the things that they do on the front end that we do in servicing now can be automated, right, Rachel or David? Can you want to expand on that a little bit?
Definitely. I mean, no,
yeah, I was gonna say one of the nice things that I would think, especially when you were talking about the borrower engagement, it's like just being able to come into a landing page that says, here's the status of your loan and whatnot, but also there's a reminder like, hey, this is upcoming. Like, think about this, you're nearing this time. You can let them know there as they're checking the status of one thing that, hey, the insurance is coming up within the next 30 days, or it's time to, send an annual tax return or whatever they're coming in. It's just sort of you always know you can show the different places. And of course, from an audit record too, you can show how often, like, yes, they've logged in, they've seen this message. We know that we've communicated that with them. And that's more to what Rachel was saying about document. How nice that you can document without trying. That is much better. And the tools are as good as your willingness to use them. And so regardless of how good of a tickler system is, if it requires you to follow up and do something, are you doing that? And so I know there's our thought process tends to be more aggressive than is realistic. I think, and I'm just saying that as, let's call us operations people. If we're doing that, we're going to, it's like, I want someone to check in them every other week. It's like, is that really feasible? And what would have changed in the last 2 weeks? So those are some things too. To Rachel's point, what you don't want to do is find yourself 4 or 5 years later and you've never even looked at it. I mean, there's just no excuse, right? But if you had set it up that you were reaching out every 6 months, okay, well, maybe that's not quite as unrealistic that you're doing that. And worse, like, you may have a banker who's calling on them, and because they're looking for an opportunity to, hey, is there anything we could do for you? Well, that counts. Like, what did they see? Especially if they met him in person, talk to him how business is going. If they invited him to a golfing event, or whatever the case may be, there's lots of different ways that servicing can be things that you're truly in touch with the borrower, and it's just a shame to miss out on that opportunity. Right. So yeah, that's kind of all over the place, but that to me is one of those.
That's very good.
It's something where tech should be. I think our goal in everything we're doing across the platform is that let the easiest path be the one that's the most prudent. So it shouldn't be difficult to, like, the effort it shouldn't be harder to do it the right way. Let's say it that way, right? Yeah. And so that really is the goal. So much of this automation, if it's at that time you realize it would be good to do some sort of a follow-up search, accomplishing that search should not be difficult. If I've made a site visit, logging the fact that I've made a site visit should not be difficult. If I've made a call out to them and whatever. And so that's really I think that's what we can be excited about. All of those things are incrementally making advances forward to where it's just far simpler to accomplish it.
Yeah.
Well, and I think that also. I'm sorry, go ahead. I was just going to say, there's so many reasons why this is such a positive thing, because it also, if it's all there and it's easily accessible, we all know that borrower that's going to reach out with that 911 of, oh, I'm closing on my property. I'm closing on my home in 10 days. I didn't tell you. Everything is there at your fingertips, and you can say, okay, well, we don't have this. We do need this. If you're going to request this particular servicing action, now is the time to deliver. And when you're caught in a situation like that we often are, especially on the lender side, where customer service is driving the bus, but you also want to ensure that you're maintaining compliance with that SOP, you can quickly respond instead of wasting, 2, 3 days while the clock is ticking on this request, while you're digging through your
Right.
file saying, oh, wait a minute, I kind of remember that a year ago, maybe we got this or that, or we didn't. So all of that helps to improve your customer service. And again,
Yeah.
going back to that compliance and the documentation in your file, which I just can't overstate.
And there's a couple other things that I've seen too. I've had lenders that will try to do everything at a single time, tie it together with maybe the borrower's year end. And at that point, ask for the insurance. Not a good method because that insurance may have expired 6 months ago.
Right.
So it's important to make sure that you have these covenants and these ticklers all independent of one another. Even insurance, they could have various insurance policies. They all could be with different companies. They can have different expiration dates. So it's important to look at each one independently. The other thing is on the financials, getting those financials and tax returns in. Sometimes that's a struggle, but you have to keep requesting it. And when it comes time that the borrower comes back and asks you for something in their loan and they haven't provided X, Y, and Z that you've already asked for, that's the time to get your file updated and request those items before you fulfill whatever request they're trying to.
Thank you. We have one other topic. Go ahead. I'm sorry, David.
So we got a couple of questions. You mind if we jump on those for a second?
Let's get this one point out of the way, and then we'll go into the questions. But basically, we've been talking about technology. The SBA came out with the Redwood score, and Okram has said repeatedly that lenders aren't using that to manage the portfolio. They're reacting when the payment goes past due. Yeah. But we won't get into Redwood today, but hopefully there's a bit more training from Okram on that. But there are other tools that we use that lenders can use that will help with that. And maybe, David, you want to start?
Yeah, and sort of the thing is, speaking to without speaking about Redwood, what I would say there is that if it's something that if there's a tool available to you that helps you indicate whether or not something is stable, something is improving or deteriorating, why not utilize it? At a minimum, that can be part of your intentional strategy. I think I've talked to a number of lenders. I've never heard anyone tell me that we just have way more than we need in our servicing group. There's just so many people here. There's almost always, to Rachel's point, you're almost always sharing resources, and it's going to always feel like you got the short end of the stick there, that you're always, I'll get to it if I can. And so what that really means is it's being strategic and intentional about what you're looking at. So if you have something that's monitoring, even as simple as, let me look at when all the payments are being made. And if you see that some of them are habitually being made within the 29 days, but more than 10 or 15 days past due, maybe start with those. If it's something that, and there could be other behavior, whether it be average balances in accounts. Because if you're a depository lender and you can see you see what that average 12-month is. If you see it dropping, if you see something interesting going on there, let that be an indicator. And you could pull that high level in a report. And so there's just lots of different ways that you can monitor it. And I would say take an intentional approach to all of those. If you can't touch them all, and you're going to get lucky to get to 10% of them, which 10% you hit is really important. So that would be something I would say.
You want to chat a little bit about the Lumos Prime Plus and the Lumos Portfolio Score for a second?
Yeah. So, I mean, that's another industry example of one. So the advantage of the Prime Plus gives you sort of like at origination an anticipated expected loss that you can kind of calculate with. And it's based on, it's like 25 years of SBA data. And so it's really good up front at giving you an idea from an industry level. What's higher risk? What should I be where should I be focused on these? And so you could do that as from the start of your portfolio, knowing that these need to be touched more often because they're going to inherently represent a higher risk from a probability of default perspective, right? They may even out on a EL level of it, but there's a higher likelihood of default on these. Okay, that's great. So maybe those are the ones you stack in order. But the other part of it is that things change from year to year. Industries, I mean, just 10 years back, if you go back and look, and there's SBA loans that are greater than 10 years, but let's just say 7 or 8 years ago, industries have changed a lot in that time period. So what was high risk then may not be high risk now, or what was low risk then may have become very high risk. And so it's important that you're sort of updating that approach. So something like a portfolio level score And Lumos has that available, right? You can do that. It's less about just this one. What does the EL now look like for this one? But it's more like as a whole, what's moving,
Yeah.
what's something that I can focus on? Because like I said, it's unlikely that at a drop of a hat you can touch every loan you have in your portfolio. I mean, if you can, that's great, but that's not realistic. Most lenders aren't able to do that. So the question is, if I can only touch a portion of them, what am I using to justify the portion I'm touching? And that, I'm sure Rachel can say more about that, but to me, that would be the greatest use of a scoring methodology like that.
Awesome. Thank you. Well, we're almost out of time. Let's get to the questions, David.
Yeah, so I'll start with is the borrower portal connected with the SBA portal or with the information and ventures? So that was the question. I don't know who wants to take that one.
I'll take it.
Okay.
So when we're referring to the LOS portal, it's completely separate. It's not connected in any way to SBA's portal. And the only information currently in the LOS that reflects ventures is payment processing. So if you're using the payment transactions of ventures, we do have an API that goes that direction. But as we build out our unified platform, it will be integrating the servicing into the portal, but that's a little ways down the road. So it's not there yet, but it will be.
This one's a bit of a longer one, so bear with me. If you are already using Ventures and now, okay, so if you're already using Ventures and now that Lenders Cooperative has merged with Ventures, is the platform going to change in terms of the interface and how processes are going to change and improve across all cycles of the loan from origination to servicing?
Sure. So if you're a Ventures user, your look and the use of the system is going to change 100%. So if you tuned into the webinar earlier this week or do the one coming up on Tuesday, or is it Wednesday, the 3rd, you'll notice the look and the feel of the LOS. So that will be, that UI experience is what you'll see as we develop the servicing components into the LOS. At the same time, we're not just bringing over Ventures as is. We're already working with working groups that are giving us feedback on what they would like to see changed. And so it's going to be 100, 1,000, 1,000,000 times better experience as we develop where it's going.
That's wonderful. So I don't know. I think I'm picking on you, Julie, so I'm sorry for that. So this last one, although this seems more of like art of the possible type thing here, but so the question is around AI and whether or not it has usefulness in the way that we service our loans, and if so, how?
Well, again, I mean, you could say the tax return reader is part of AI. Can we also read documents? Possibly that's something that maybe as an insurance policy gets uploaded. Can we pull the data from the insurance policy to then match up what is the required amounts in the loan covenant area? So, those will be things that we can look at. How can we best use AI in those types of instances?
Yeah,
See it on the front end, David. Yeah.
Yeah, so I was going to say, one of the things I know that we learned during PPP, right, was that now part of it was the unique circumstance, sure, but part of it was that business owners are busy running their business. So oftentimes when they're interacting with a portal is not exactly during those 8 to 5 business hours. It's often in the evening or on the weekends. And so the ability to help them self-service is going to be critical. And something like AI, especially when it comes to just basic, what are you trying to accomplish? What are you looking for? Can go a long way toward helping them, so that they're not reliant on waiting on someone being available during, even if it's extended business hours at 11 o'clock at night. Odds are you're not getting somebody, right? And so I would think that's another opportunity where it can really assist that business. And it's like if they're trying to make a payment, or if you're trying to check on this, or I need to see about starting a modification. How do I go about doing that? All of those. It's a big step forward from something simply like an FAQ. And on the operations side of it too. I would think the opportunities in let's call it analysis. What AI isn't is a magic bullet. It's not going to be something that just is immediately solves all items. Number one, accuracy is going to be the thing that really matters. And so you're going to want to make sure if you're pulling in information together, you're not opening yourself up to something that you're not getting consistent output, what you're expecting, right? So if it's a deterministic sort of model approach type to it, and I'm probably butchering those words, then that's the thing you can rely on. So there's automation gives us all kinds of opportunities for speed, for efficiency, so that I can make a small effort and that turn into a much larger output. But it's going to be important that as we're testing, that regulators are happy with what they're seeing, that there's not concerns for security, that all of those things are being addressed as you go. And I think we've got a really interesting roadmap to look forward to there on that, especially on the originating front. I mean, the speed with which you can what was it? There was the FDIC, I think, partnered or sponsored a large small business survey that went out, and speed to the funding, like their ability to get to the loan decision the quickest, is one of the highest things of importance to a small business. That's the thing that matters most to them. Right up next to that is having a relationship with the lender, so someone they can talk to and understand. But the problem is speed will often outweigh the smarter decision of who do I talk to if I have a problem. And so that we want to be there to help equip every lender to be able to be there, so that the speed's not the issue. Instead, you can have that relationship with the business that's the most important.
Great. But we're at our time. David, Rachel, Julie, thank you so much. And Julie, the next one's next Wednesday on the 3rd.
Yes.
So
so if you're and if you're a Ventures user, you have access to the on your announcement widget to click the button to register. And if you're not a Ventures user and you want to know more or be part of that discussion, you can check an email and we'll make sure to get you registered.
Thank you. And our next one, as I said, is going to be recorded. So you'll each have a link to hear what Hilda Kennedy, Danny Mangum, Michelle Verveleid, Sherry Martin, and Brett Shirley have to say about the SBA going forward. Thank you all.
Thank you. Have a nice day.
Thanks, everybody.